Ever feel like someone's pulling the strings on your money? Meet the Federal Reserve, the puppet master behind the economy. So, how does the Federal Reserve control your cash without you even noticing? Founded in 1913 after a secret meeting on Jekyll Island, it serves as the central bank of the United States. Its mission is to stabilize the economy, ensuring that inflation remains steady. Research shows that a stable economy fosters growth and job creation. For example, during the 2008 financial crisis, the Federal Reserve took decisive action. They lowered interest rates to encourage borrowing and spending, helping to revive the economy. So, next time you think about your finances, remember who's behind the curtain. Understanding the Federal Reserve can help demystify your money matters. Curious to learn more? Continue watching as we dive deeper into this topic in the next segment of this video.
Ever feel like your money doesn't stretch as far as it used to? Groceries cost more, rent keeps rising, and somehow, the people in charge always have an explanation. But who's actually pulling the strings? Who decides how much your money is worth, how expensive borrowing gets, and whether the economy soars or stumbles? The answer? The Federal Reserve. They're the ones turning the dials on the economy, adjusting interest rates, managing inflation, and sometimes, just sometimes, creating problems they later have to fix. You might think the president or Congress calls the shots on our financial system, but nope. The Fed operates independently, meaning their decisions can shake entire industries, move markets, and impact your bank account without a single vote from you. So, how does this one institution hold so much power over your money? And more importantly, what does that mean for you? Let's break it down. All right, let's start with the basics. The Federal Reserve, aka the Fed, is the central bank of the United States. It was created in 1913 after a series of financial meltdowns made it clear that America needed a referee to prevent banking collapses and economic chaos. But here's where things get interesting. The Fed isn't part of the government in the way you might think. It operates independently, meaning neither the president nor Congress can directly control its decisions. And yet, its policies influence everything, from interest rates to job markets to the value of your savings. The Fed is made up of 12 regional banks, each overseeing a slice of the country's economy. They gather data, monitor financial conditions, and work with local banks. But the real power lies with the Federal Reserve Board of Governors, a small group of people who decide policies that impact your mortgage, the stock market, and even how much a cup of coffee costs. So, why should you care? Because the Fed is responsible for two major things: controlling the money supply and setting interest rates. In other words, they decide how easy or expensive it is to borrow money and how much inflation eats away at your paycheck. And when they get it right, the economy grows steadily. When they get it wrong, well, let's just say history has some interesting lessons on that. But before we get into their biggest blunders, let's talk about their favorite tool, interest rates. So, now that we know the Fed exists and that they're basically the most powerful club you weren't invited to, let's talk about what they actually do. Because trust me, this isn't just a bunch of economists sitting around debating over lattes. This is real power over your money. The Fed has two main tools: interest rates and money supply. Think of them as the economy's gas pedal and brake. When things heat up too fast, hello inflation, they tap the brakes by raising interest rates. When the economy is too slow, think recessions and job losses, they hit the gas by lowering them. Raising interest rates makes borrowing more expensive. Mortgages, car loans, credit cards, everything costs more, so people spend less. Businesses also borrow less, slowing down expansion and hiring. This is the Fed's way of cooling off inflation. On the flip side, when the Fed lowers rates, borrowing gets cheap, people take out more loans, and businesses expand. It's like an economic caffeine shot, but if overdone, it leads to too much spending and, yep, you guessed it, inflation. The tricky part? If the Fed raises rates too aggressively, they can accidentally crash the economy into a recession. If they're too slow to act, inflation spirals out of control. Sound familiar? That's because we've seen both of these scenarios play out in real time. But wait, there's more. The Fed doesn't just adjust interest rates. They also control how much money is floating around in the economy. And no, this isn't about physically printing bills. It's about creating digital money through a process called quantitative easing, which is a fancy way of saying, let's inject some cash into the system and hope it helps. They do this by buying government bonds from banks, essentially giving banks more money to lend. More lending equals more spending, equals economic growth. But if they overdo it, inflation skyrockets, and suddenly, your dollar doesn't go as far. Now, here's where things get interesting. Does the Fed always get these decisions right? Not exactly. Let's talk about what happens when they really mess up. We've talked about interest rates, but let's get into something even more controversial, money printing. Or, as the Federal Reserve likes to call it, expanding the money supply. Sounds harmless, right? Well, history would beg to differ. Most people assume money comes from printing presses at the US Treasury. But in reality, most new money isn't printed. It's created digitally. The Fed doesn't need stacks of cash. All it takes is a few keystrokes. Here's how it works. When the Fed wants to inject more money into the economy, they buy government bonds from banks. The banks then have more money to lend. Businesses borrow more, and people spend more. Sounds great, until there's too much money chasing too few goods. And that, my friends, is inflation. Why too much money leads to inflation? Imagine you're at an auction bidding on a rare collectible. If there are only a few buyers, the price stays reasonable. But if suddenly, everyone gets a pile of free cash, bidding spirals out of control. The same thing happens in the economy. When too much money is pumped in, prices rise, and your dollars lose value. That's why after the government and Fed injected trillions into the economy during COVID, inflation took off like a rocket. Suddenly groceries cost more, rent skyrocketed, and wages couldn't keep up. The money supply expanded, but the number of goods and services didn't. The consequences of out-of-control inflation. So, what happens when inflation spirals out of control? It's not just about paying more at the grocery store, it can destroy entire economies. Let's look at a few times inflation ran wild and what it did to people's lives. The 1970s stagflation crisis, the economy's worst nightmare. The 1970s weren't just about disco and bell-bottoms. They were also an economic disaster. Inflation shot up above 12%. Gas lines stretched for miles. And wages couldn't keep up. People's savings lost value overnight. And even with jobs, they felt poorer every month. Why? Because the Fed had kept interest rates low for too long, letting inflation creep up. Then, when it finally tried to fix things, it had to hike rates so aggressively that it caused a deep recession. Imagine trying to buy a house with interest rates at 18%. That was reality for homebuyers in the early 80s. It took years of economic pain before things stabilized. And the lesson? The longer you let inflation run, the harder it is to stop. The 1940s post-war inflation crisis. Too much money, too fast. Now, let's rewind to the late 1940s, another period when inflation surged. After World War II, the US had pumped massive amounts of money into the economy to finance the war effort. Factories were producing at full speed, the government was spending at record levels, and suddenly, millions of soldiers were returning home, ready to start spending. The problem? Too much demand, not enough supply. The Fed had kept interest rates artificially low to support war financing. And when the war ended, inflation exploded, hitting nearly 20% in 1947. Prices on everyday goods doubled in just a few years. Rent, food, and transportation costs soared. People's savings lost value fast, and the economy became overheated. The Fed had to step in aggressively, raising rates and tightening money supply to slow things down. It eventually worked, but not before millions of Americans felt the painful effects of rising prices. The United States today. Are we heading there? Now, the US isn't facing post-war inflation, but we are dealing with something similar. Massive stimulus spending followed by inflation spikes. After COVID, trillions of dollars were pumped into the economy, interest rates were kept near zero, and demand surged past supply. And while we're not seeing 1940s level inflation, we are seeing something just as dangerous, inflation that lingers. If the Fed raises rates too fast, it could trigger a recession. If it does nothing, inflation might stick around for years, eroding wealth and making life harder for millions. So, what happens next? The Fed is trying to fight inflation by raising rates, but what does that mean for your wallet? Let's break it down next. To fight inflation, the Fed's only real option is to slam the brakes by raising interest rates, making borrowing more expensive and slowing down the economy. But if they raise rates too aggressively, they could trigger a recession. And if they don't act fast enough, inflation sticks around longer, making life even harder. Either way, there's no easy fix. So, how does all this affect you? From your mortgage to your savings account, let's talk about what inflation means for your wallet next. So, we've talked about how the Fed controls interest rates and money supply, but let's bring this closer to home. How does all of this actually affect your daily life? From your mortgage to your credit card bill, the Fed's decisions ripple through every part of your finances. First, the cost of borrowing. Why loans get expensive. Let's say you're looking to buy a house. A year ago, that dream home came with a reasonable mortgage payment. But now, after the Fed raised interest rates, that same home could cost you hundreds more per month in interest alone. It's not just houses, car loans, student loans, and credit cards all get more expensive. The higher the Fed raises rates, the more borrowing costs eat into your budget. Second, inflation versus wages. Why you feel poorer. If inflation rises faster than wages, your paycheck doesn't go as far. Even if you get a raise, the cost of living might be rising faster than your income. Groceries, rent, gas, it all adds up. And this is where the Fed's balancing act gets tricky. If they raise rates too high, businesses slow hiring and wage growth stalls. If they don't raise rates enough, inflation keeps eating away at purchasing power. Either way, you feel the squeeze. Third, jobs and recession risks. When the Fed hikes rates aggressively, companies pull back on hiring, layoffs increase, and job markets tighten. If you work in an industry that depends on cheap financing, like tech, real estate, or retail, you might feel the impact first. Small businesses get hit hard too. They rely on loans to expand, and when borrowing costs spike, many struggle to survive. All right, so we know the Fed controls interest rates and the money supply, but what happens when they take a wrong turn? Well, let's just say history is full of epic fails where Fed policies made things way worse. And when they mess up, we all pay the price. The problem is, controlling the economy isn't like adjusting a thermostat. It's more like trying to steer a cargo ship in a storm. One wrong move, and boom, financial chaos. So, let's look at some of their biggest mistakes and what they got so horribly wrong. The Great Depression, when doing nothing made everything worse. Rewind to the 1930s. The stock market had just crashed, banks were failing left and right, and millions of Americans were out of work. So, what did the Fed do? Did they pump money into the economy to stabilize things? Did they lower interest rates to encourage borrowing? Nope. They did the exact opposite. The Fed tightened the money supply when the economy needed it most, making it harder for businesses and consumers to access credit. The result? A financial death spiral. Unemployment hit 25%, thousands of banks collapsed, and the US economy didn't fully recover until World War II forced massive government spending. Moral of the story? Sometimes, doing nothing, or worse, making the wrong call, can turn a bad situation into an economic apocalypse. The 1970s stagflation disaster, the Fed's worst balancing act. Now, fast forward to the 1970s, arguably the most miserable decade for the economy. The US was dealing with something called stagflation, a nightmare mix of high inflation and high unemployment. Usually, inflation happens when the economy is booming, but this time, people were losing jobs while prices kept climbing. It was like trying to put out a fire while someone was throwing gasoline on it. So, how did the Fed respond? Not great. They kept interest rates too low for too long, allowing inflation to spiral out of control. By the time they finally acted, inflation had hit double digits, and it took a brutal recession in the early 1980s, along with sky-high interest rates, to fix the mess. Lesson learned? If the Fed waits too long to fight inflation, the cure can be worse than the disease. The 2008 financial crisis. The Fed's bubble-bursting blunder. Now let's talk about one of the most infamous Fed mistakes of modern history, the 2008 financial crisis. The lead-up to this disaster? A housing market bubble fueled by, you guessed it, low interest rates. After the dot-com bubble burst in the early 2000s, the Fed kept rates at record lows for years. This encouraged risky lending. Banks were handing out mortgages like candy, and people were buying houses they couldn't afford. Wall Street took those risky loans, bundled them into investments, and sold them like hotcakes. And then, the bubble popped. Home values crashed, banks collapsed, and millions of people lost their jobs. The stock market tanked, and the Fed, who had helped create the problem, had to step in with trillions of dollars in bailouts to prevent total economic collapse. Moral of the story? Keeping money too cheap for too long can create bubbles that eventually explode in everyone's face. Today's inflation mess. Are we watching another Fed mistake in real time? That brings us to today. After years of ultra-low interest rates and massive stimulus spending, we're now dealing with the highest inflation in decades. Groceries cost more, rent is through the roof, and wages aren't keeping up. And now, the Fed is scrambling to fix the mess, raising interest rates at the fastest pace in modern history. But here's the problem. If they go too far, too fast, they could send the economy into a recession. If they don't do enough, inflation could stick around for years. Sound familiar? That's because we've seen this pattern before. And if history tells us anything, it's that the Fed doesn't always get it right. So, the real question isn't just what went wrong, it's how do you protect yourself from the next Fed mistake? Let's talk about that next. So, the Fed's decisions don't just affect Wall Street, they hit your bank account, your job, and your cost of living. But here's the good news. You don't have to just sit back and take the hit. There are ways to protect yourself from these shifts, and that's exactly what we're going to talk about next. 1. Be smart about debt. When the Fed raises rates, borrowing gets expensive, fast. The smartest move? Manage your debt before it gets out of control. Lock in fixed-rate loans. If you're carrying a variable-rate mortgage or loan, refinancing into a fixed-rate option could save you thousands. Avoid credit card debt. Like the plague, interest rates are already high, and when the Fed raises rates, they climb even higher. Paying off balances quickly or switching to a 0% APR balance transfer card can save a lot of money. Time big purchases. Wisely. If borrowing costs are rising, waiting to buy a house or car could save you serious money. 2. Prepare for job market shifts. When the Fed tightens the economy, companies cut back. Layoffs, hiring freezes, and shrinking wages follow. Here's how to stay ahead. Build an emergency fund. 3 to 6 months of living expenses can act as a financial cushion in case of job loss. Consider recession-resistant careers. Healthcare, essential services, and education tend to hold steady during downturns. Negotiate a raise before it's too late. Hiring slows before salaries do, so securing a raise while companies still have room in their budgets is a smart move. 3. Watch the Fed and plan ahead. Most people don't follow Fed policy until they're already feeling the effects, but knowing what's coming can give you a major advantage. Follow interest rate announcements. The Fed meets regularly to adjust rates. Staying ahead of their decisions can help with loan and investment planning. Watch for policy shifts. If the Fed stops raising rates or starts lowering them, it usually signals a major economic shift is coming. Learn from the past. The Fed has made mistakes before, and they'll probably make them again. Understanding historical patterns can help anticipate what's next. Final thoughts. The Fed moves, you react. The bottom line? You can't control the Fed, but you can control how you prepare for their decisions. Whether it's managing debt, watching the job market, or making smarter investments, staying informed is the best way to stay ahead. So, what do you think? Is the Fed stabilizing the economy or just making things worse? Let's keep the conversation going. Drop a comment below and subscribe for more breakdowns like this. And if you're looking for ways to protect your finances in times of inflation, I cover the best bank bonuses, savings hacks, and investing strategies over at moneysmylife.com. Check it out for more ways to make your money work for you.